Today is Thursday, 22nd of May, 2025 Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. The financial markets are currently navigating a landscape marked by a juxtaposition of optimism in the technology sector and cautiousness due to global uncertainties. As investors digest a myriad of factors influencing market sentiment, major indices have shown a mixed momentum. The tech sector took center stage, bolstering gains and reinforcing its position as a pivotal driver of market performance. This sector has consistently exhibited resilience and innovation, which continues to capture investor interest and propel market optimism. Conversely, the broader market remains vigilant amid a backdrop of geopolitical tensions that are influencing commodity and currency movements. These uncertainties have injected a degree of caution among investors as they assess the potential implications on global trade and economic stability. The interplay between these dynamics underscores the complexity of the current economic environment, where optimism and caution seem to walk hand in hand. Commodities have responded noticeably to these geopolitical cues, with prices fluctuating as markets attempt to price in potential disruptions in supply chains and shifts in global demand. Meanwhile, currencies are also feeling the ripple effects, with movements reflecting both localized economic conditions and the broader geopolitical landscape. Overall, while the technology sector's upbeat performance provides a buoyant note, the mixed momentum across markets highlights the need for investors to remain attentive to both opportunities and risks. This balanced approach will be crucial as the markets continue to navigate through these uncertain times, seeking clarity from upcoming economic data releases and geopolitical developments. As always, Preeti Capital remains committed to providing insightful analysis to help investors make informed decisions in this dynamic environment. The financial markets experienced a broadly negative day as major indices across the globe reflected investor trepidation. In the United States, the leading indices showed significant declines, with the S&P 500 dropping by 1.61%, the Nasdaq Composite falling by 1.41%, and the Dow Jones Industrial Average experiencing a more pronounced decrease of 1.91%. The Russell 2000 Index, which often serves as a barometer for domestic small-cap stocks, tumbled by 2.80%, indicating broader concerns about economic conditions affecting smaller businesses. Volatility, as measured by the VIX index, spiked by over 15%, highlighting heightened uncertainty and risk aversion among investors. This increase suggests a growing apprehension in the market, potentially driven by macroeconomic indicators or geopolitical developments that have heightened risk perceptions. In Europe, the market sentiment was more tempered. The FTSE 100 showed a marginal gain of 0.06%, while Germany's DAX index rose by 0.36%. These modest upticks suggest that European investors might be somewhat less perturbed by the current market environment, or are finding some sectors resilient in the face of global pressures. Turning to Asia, the Nikkei 225 in Japan decreased by 0.84%, and Hong Kong's Hang Seng Index fell by 1.13%, pointing to a cautious stance among Asian investors. The Shanghai Composite Index in China marginally fell by 0.18%, reflecting a relatively stable outlook compared to its regional peers. Overall, the global financial landscape appears to be under pressure, with American markets leading the downturn. The surge in the VIX indicates that investors are bracing for continued volatility, possibly due to evolving economic indicators or geopolitical uncertainties that may impact market dynamics in the near future. The mixed performance in Europe and Asia suggests a cautious optimism or specific regional factors at play, moderating the overall decline seen in the US markets. In recent financial market developments, bond yields have showcased notable movements, reflecting shifts in investor sentiment and economic expectations. The yield on the 10-year Treasury note has risen to approximately 4.60%, indicating an increase of 2.57%. This movement can be indicative of investors demanding higher returns for holding government debt, possibly due to expectations of sustained economic growth or concerns over inflationary pressures. As yields rise, the price of bonds typically falls, suggesting a possible reallocation of capital towards riskier assets or a reaction to anticipated monetary policy adjustments. In contrast, the 13-week Treasury bill has experienced a slight decline, with its yield decreasing by 0.31%. Such a contraction could suggest a short-term flight to safety, where investors seek the relative security of short-term government securities amid potential market volatility or uncertainty. Typically, this might occur in anticipation of economic slowdowns or geopolitical tensions, prompting investors to park funds in instruments with less exposure to interest rate changes. Meanwhile, the long-term 30-year Treasury bond yield has increased by 2.48% to reach 5.09%. This upward movement in long-term yields could signal expectations that inflation may persist over the longer horizon, or it might reflect adjustments in fiscal policy and government borrowing plans. As the yield curve flattens or steepens, it is a crucial indicator for market participants to interpret future economic conditions and monetary policy trajectories. Overall, the bond market's current dynamics reveal a complex interplay of factors, including inflation expectations, economic growth forecasts, and central bank policies. These yield changes not only impact the fixed income market, but also have broader implications for interest rates across the economy, influencing everything from mortgage rates to corporate borrowing costs. Investors will continue to monitor these trends closely as they navigate the evolving financial landscape.